Robschild, no investment advice. Welcome to the show where we view financial markets using Benjamin Graham's investment philosophy, macro, technicals, and crystal ball gazing in that extremely specific order. Today is Sunday, February 9th, 2025. As I explained in the past few episodes, I've decided to switch from doing a Friday show to doing a Sunday show. I find that it may be more useful for Monday since markets are open on Monday. Today's episode begins with the unemployment employment report that came out Friday. Huge report. I continue to expect a rocket ship takeoff in the unemployment rate, and yet we don't see that yet. In fact, we saw the unemployment rate drop from the previous month of 4.1%, also lower than the expected amount of 4.1% at only 4.0%. This is accompanied by U.S. hourly wages higher than both the last and the expected 0.3% being the actual 0.5%. So that's super inflationary, right? And that means bond yields have to go to the moon. Well, the 10-year note yield only went up by about 1%, notably only basically closing still below this line here. And so the way that I see it, yields are still bearish, even though the employment news was all positive. I would have expected, honestly, for yields to be spiking here off of these numbers. And they're not, which means the bond market is sniffing out something else. An article I came across from marketwatch.com, the bond market just sent a message about Trump's second term. Stock investors should listen. This article discusses the calm in bonds, suggests it's time to pencil in stocks you like. The point of all of this is that the bond market is waiting to see what happens next. And like I said on Thursday's show, I think that headline is actually more important than other people. No one else is talking about this. The fact that him and Bennett are coming out talking about, no, when we're talking about interest rates going down, we were talking about the 10-year note. Well, you don't control the 10-year note, not even one little eensy little bit. Yeah, and that's good news. And it's like, so now it's like, this is a very nice situation for investors, honestly, because, what's going to happen is you have the executive branch, right? The United States president figuring out, how am I going to keep yields low and, get done what I want to get done forever, including Lynn Allen has been speaking continuously, nonstop, about how Trump's not interested at all in cutting fiscal spending. And yet I'm seeing this happening. I'm seeing there was an article that came out recently about already $23 billion cut to government spending, and it continuing, and they're going into the Treasury trying to figure out where money is going. Fiscal responsibility, from my perspective in my crystal ball, it seems to be emerging out of the dust here a little bit. And for me personally, this is a very, very positive sign. This is, Trump saying, I'm willing to not do things that freak out the bond market because I don't want rates to go higher. That's like the golden message. That's exactly what should be happening here. And it's very encouraging, and it should be encouraging for all investors, because lower yields for everyone means that, stock valuations don't necessarily need to go lower in the face of bond yields currently still staying higher. It'll be super, super interesting to see how all of this ends up panning out, any way that it ends up going. Anyhow, no changes in the daily reminders. Still, the macro update 110.25 dominoes in the ball in the thumbnail. Watch that video to hear me read through these extremely important daily reminders. These are still very valid and important things to be highly, highly aware of. Also, no major changes in the crystal ball readings nor the Robschild portfolio, which I also explain in that show. On to the charts. S&P 500 cracking lower off of this news. Unemployment is lower than expected, so that's good news. So we're apparently back into that situation where bad news is good news because of rates. If rates are going to be higher, then that's bad for equity valuations. Apparently, that's where we've regressed to, at least the way that I'm looking at it now. Mr. Market, generally speaking, is not a very predictable person. TLT, still my favorite place to be. Unfortunately for me, with 59% of my portfolio in basically TLT, we broke down. I was expecting this line to hold here, this little trend line, and instead we broke down. Notably, though, open and close still solidly above the Head and Shoulders top. Again, I sort of agree with this headline, at least from Market Watches, that the bond market is, in a state of calm. It doesn't know what to do. It's sort of waiting for the next headline to be like, we're going to spend a bunch of money here, or we're going to stop spending here. And, with me and my crystal ball, they seem to be going in the direction of cutting spending. That's what I'm seeing. I don't know if apparently the bond market, look, the bond market is far more, I'm going to say, intelligent and aware of the full picture than me. I don't know that, honestly, the bond market is Mr. Market himself. You go back to Benjamin Graham's time back, 1930s, 1940s, especially, where you could get bonds at an unbelievably cheap deal. Like, bonds aren't necessarily all right. They tend to be much more intelligently priced than stocks do, but they can become overvalued and undervalued. Anyway, when you look at, tier 3, and by tier 3, I mean number 1, Benjamin Graham's, investment philosophy. Bonds in general yield a heck of a lot more than stocks do, so much so that it seems that bonds are in, cigarette butt mode and stocks are in a bubble, very clearly, to me, based on simply stock valuations versus bond yields. And then again, watch the macro show to see the macros. But thirdly, the chart patterns. This does not suggest a bearish pattern at all. If anything, a gap fill. So more than anything, I would suggest that bonds are now neutral and exactly the same as Market Watch is saying. There's a calm in bonds. They don't know what to do right now. But me and my crystal ball say yields they're about to go down. Where's the demand coming from? Where is the economic boom coming from? We have birth rates that are lower than they've ever been, along with, however you see it politically, the immigrant situation is, what's going on there. With less people, you need more people for bond yields to go up. Let's just say that. Equally, in TNX, the 10-year Treasury note yield, the upside down version of this, whichever chart pattern you want to use. I've been using this little trend line here going back to the September of 24. We're still solidly under this, and so there's still a bit of a bias to the downside for yields, the way I see it. Similarly, in the 10-year break-even inflation rate from the Fed, it just looks so sideways here. And yeah, this market is saying, we don't know what to do here. Another important piece of the puzzle, 10-year minus 2-year Treasury spiking downwards. And so, This obviously happens when longer yields are going up in the face of shorter yields staying flat. And yeah, they went up a little bit today, not so much. I wouldn't be surprised if this stops at this point. But it's always an important thing to keep an eye on. If we continue the directionality of this chart looking currently like it's falling precipitously, back towards this thicker black line here being 0, towards an inverted state. Again, the way I see this, if we reinvert, all it does is prolong the inevitable, recession, which the longer things stay inverted, the worse recessions or depressions tend to be. I'll see how it all works out again. With the S&P 500 and TLT dropping decently on the same day, and yet Chinese equities looking like they're taking a bid here on an opening basis, higher than the last highest close. Not looking super bearish, I'll say at the least. This fund represents about 13 or 14% of my own personal portfolio. I'll add gold is starting to not look as bullish as it had previously looked. I had mentioned since we broke the double top line, it looked like we were likely headed up to that psychological 3,000 level, and yet over the past 3 days, this is looking less straight up and a little bit more sideways. I'm starting to wonder if we may even be at a top in gold. Lastly, Bitcoin. Holy moly, look at these candles, these daily dojis, one after another. Battle zone in the middle of this parallel trend line here, just battling it out in this very middle zone. This is very, very neutral. If I were to guess with my crystal ball and all, I'd say that Bitcoin's about to... I think Bitcoin might be at its last stand right now, actually. But again, that's just me and my crystal ball, and that's all from my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.